Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Lead Partner. Welcome to our IFRS Insurance Webcast. Moving Ahead is today's webcast title. The IASB discusses contracts with participating features and takes decisions on 4 non-targeted issues. As always, the agenda is structured around 3 items. I'll start by giving you the highlights of the decisions from the IASB meeting this month, followed by a much more detailed discussion around the IASB staff recommendations and board discussions. I will then finish with a few minutes on the next steps and updates on timetable before opening the floor for any questions. On the 20th of May, the IASB held an educational session, which is a non-decision-making session on possible adaptations for contracts with participating features. In our opinion, this is the most challenging issue that remains to be dealt with during the redeliberation process of the IASB. And it is only to be welcomed the fact that the IASB has given such a large amount of time, an entire session, to prepare for the decision-making discussion that is expected to take place next month and in July. The discussion revolved around whether these adaptations for contracts with participating features are needed for the IASB to move forward from the mirroring approach presented in the 2013 exposure draft. The alternative approach proposed by the European CFO Forum and similar to the Deloitte proposal that we provided in our comment letter last year were considered in describing the various adaptations. At this stage, there were no staff recommendations or board decisions. On the following day, 21st of May, the IASB met again and decided upon 4 of the 7 non-targeted issues that they have agreed to consider. The first decision is to introduce additional guidance on how to recognize the contractual service margin to profit or loss over the coverage period and what the systematic way of recognition is in the context of non-participating contracts. The second decision was around the scope exclusion included in the 2013 exposure draft, which has now been changed into an option to account for these type of insurance contracts either as insurance contracts under the new insurance contract standard or within IFRS 17, the new standard published yesterday on revenue from customers' contracts. The third decision was to retain the additional guidance in the revised exposure draft that significant insurance risks occurs only when there is a possibility that an insurer incurs a loss on a present value basis. And finally, the board decided that they would like to clarify the accounting for contracts acquired through a business combination or a portfolio transfer, particularly when the underlying coverage has already expired at the time these contracts are acquired. And they decided that the claims handling period would then be used to release the CSM recognized on acquisition over time. Let's now dive into the educational session and try to understand the 4 components of the paper that the IASB staff presented to the board. The first issue is around measuring the fulfillment cash flows. The main issue here appears to be whether different discount rates need to be applied to cash flows that vary and those that do not vary with underlying items. During the discussion, we noted that the staff informed the board that there are techniques based on their outreach activity that would appear to be able to respect the different nature of the underlying cash flows and still apply a single yield curve to reflect the time value of money. They also noted that it is important to observe that in spite of these techniques existing, the division of cash flow by type and the application of the appropriate discount rate may still be needed in order to provide consistency in the measurement of the contractual service margin and the presentation of interest expense. There were a number of comments, but we thought that three of these comments were particularly important and we wanted to draw your attention to them. The first one is that the board members noted and confirmed that they would be pleased if the book yield approach, which is deriving the P&L discount rate from the accounting-based asset return that is used for recognizing income from the underlying items, is only used for presentation purposes. And the measurement of the participating contract liability and its cash flows remains based on current market interest rate yields feeding into the yield curve that is used for balance sheet. That gives us already a view on another topic that is covered later on in the webcast, that is the presentation of interest expense and how accounting mismatches could be mitigated by the use of this book yield approach. The second point is that having heard the discussion from the staff around these various techniques and the application of different or single discount rates to a bundle of different types of cash flows, the board felt that it was important to alert the staff that their preference is to remain focused on objectives of the standard and the four principles, rather than introducing detailed prescriptions on the techniques that an insurance company would need to use. So this directional decision, if you like, should be reflected in the preparation of the papers that will be tabled for discussion next month. Finally, the board acknowledged that many respondents didn't like the mirroring approach in the 2013 exposure draft, given the material operational issues that this approach would create. And that is an important point, given that the IASB, by making those comments, has already given us an indication that they are developing a mindset that is likely to be in favor of abandoning the mirroring approach in the final standard in favor of something else. And the discussion last week was really all about what is this alternative accounting model about and how can it be brought into the new IFRS in a way that is satisfactory from the IASB perspective. The second topic on the participating contract accounting is the measurement of the CSM. This is really, in our opinion at Deloitte, the most critical adaptation to the existing accounting model for insurance contracts. And the main issues around the measurement of CSM are, first of all, the recognition pattern. And that's why you understand why the decision the following day on the CSM measurement pattern for non-participating contracts was restricted carefully to just that type of insurance. The second is how changes in the estimates of investment returns that come from underlying items should be treated in terms of the impact that they will have on amounts paid to policyholders. The board commented that some participating contracts, in terms of the ability the insurer will have to award the policyholder with a portion of the returns generated by the underlying items, are actually based on a fairly extensive degree of discretion. On the contrary, there are others that are subject to a much more rigorous and strict set of regulations that limit the discretion of the insurance company. The board mentioned all these things, which were covered quite extensively in paper 2A, the background paper on participating contracts from an understanding of its economics point of view, as a potential risk that this diversity could make it difficult for them to prescribe one model for all forms of participation. The second important comment they made on this point is that if such diversity would then require bespoke solutions to accommodate the diversity, the board was afraid that it may result in more difficulty and complexity, which would make it therefore more difficult for the board as a whole to approve this standard setting direction as one that can deliver effectively higher benefits than costs to implement it. So these comments would appear to indicate that the degree of complexity that the new requirements would carry with them is an important variable, but there is also an acknowledgement that the diversity of participating practices around the world, unit-linked, with profit, universal life, etc., would still represent the most difficult conceptual hurdle for the IASB to overcome as they try to deliberate for the final time the accounting treatment for these type of contracts. It is also important to remember at this point that we are looking at a type of contracts here that spans across two different categories of transactions. We can have both insurance contracts with participating features as well as financial instruments with participating features. In both cases, the IASB has decided that the accounting will be retained within the IFRS 4 Phase 2 standard. The only exception to this decision is the absence of any kind of discretion in the form of participation that the insurance customer will have from that contract. In that instance alone, the participation would be non-discretionary, and the accounting for those financial instruments will still be conducted under the requirements of IFRS 9. There was also discussion about whether it would be appropriate to unlock the CSM for explicit and or implicit investment management fees, and this produced a kind of extensive debate and mixed opinions within the board members. The issue here is that on one side, for explicit management fees, the board was able to understand the logic and the economics, given that the explicit nature of that fee structure allows them to see how the economics will be reflected in the financial statements. This is typical of contracts such as unit-linked policies that declare in the terms and conditions of the policy that there is an explicit charge the insurance customer must pay by allowing the insurance company to deduct from the value of the contract a percentage of its value. That is the fee that is paid explicitly for the receipt of the service. Other situations, much more common in the discretionary participating situations, will have a gross distributable return, however determined by the contractual clauses available for the company to award to the policyholder based on particular constraints, which could be minimum retrocession rates or the decision to establish the amount of the total return in a year that would be available for distribution. Any component of that return, gross return, that is retained by the insurance company is seen by the IASB staff and the board as an implicit investment management fee. The issue here from an accounting perspective is whether the generation of that potential return as a result of the implicit fees emerging from the return on the assets is to be treated as revenue within the period in which the return of the asset is accounted for, or whether it should be subject to a different treatment. We at Deloitte have expressed a clear view on that difficult judgmental matter. We believe that the participating feature which is offered by the company to the customer is the key service being delivered. And the performance of activity to manage the production of those returns is not complete until such returns are awarded to the company's customers. That means that unless there is a complete absence of discretionary decisions, it is the declaration of the award that makes the process of fulfilling that obligation complete, and from our point of view, the point in which profit and revenue should be recognized in the financial statements. This is also very similar to what the insurance European industry is proposing in their alternative approach, and clearly is an area that the board has been focusing their attention in preparation for the decision-making session next month. The third area that was discussed on participating contracts is the changes in the value of options and guarantees. The main issue here is the accounting for changes in the insurance liability from embedded options and guarantees that are not unbundled as freestanding derivatives. The options that were considered during the discussion were an accounting through profit and loss, an accounting through other comprehensive income, or a recognition against the contractual service margin. The staff of the IASB observed that these optional guarantees, if they were accounted for against the contractual service margin, they could cause an accounting mismatch, particularly if the insurer had purchased freestanding derivatives to hedge the exposure from those optional guarantees. The reason being that those derivatives would be accounted for always through profit or loss, and that could create a different treatment. At Deloitte, we actually have a different perspective here, which I would like to share with you. We believe that this situation is not necessarily automatic as the staff presented it. We believe that in most instances that we have been checking around the global insurance markets, such derivative structures are acquired by insurance companies, but they are held within the same participating fund where the underlying items are kept to produce the returns that will be then shared with the policyholders. If the approach that I described earlier of unlocking the contractual service margin for the full amount of the returns generated by the underlying items prior to attribution to the customer is adopted, the gains and losses from the derivative instruments would also be taken into account, and there would not be any accounting mismatch. We have found very rarely situations where the hedging of a participating business is conducted outside of the participating fund. One board member stated that if the board did not like the use of the CSM, they would need to move to the profit and loss account option and discard completely the OCI solution on the grounds that it would be compound the complexity of the accounting method. And finally, there were a few clarifications which we felt were useful for all of our customers around the world to understand. First of all, the staff clarified that surrender options are not options included in this discussion, so they're not looking really at surrender options in terms of the discussion on participating business. They are looking at guarantees primarily and options that produce an impact which is asymmetrical vis-à-vis the value of the underlying items. They also clarified that the consequential effect of any decisions taken on measurement presentation, including the use of OCI for participating contracts, would need to be explored again later. And that the locked-in discount rate, which applies to non-participating contracts, will not work for participating contracts. The last piece in particular is again another clue that the discussion has given us as to the direction that the IASB is already taking in terms of preparing for the decision session next month. The last topic covered in the educational session is the presentation of interest expense. And the main issue here related to the presentation of interest expense when the OCI solution is adopted. If the assets, the underlying items, are all accounted for at fair value to profit and loss, this issue has got virtually no relevance to the financial statements. But if it does happen to apply to a company that has been using other than fair value to P&L for the underlying items, then it does matter. The book yield proposed in the Deloitte response letter and in the European insurance industry alternative approach requires the insurer to use those accounting returns from the underlying items, however they have been reported, as the basis to derive the book yield, which is then presenting in the financial statements the time value of money for those participating liabilities. The staff noted that there could be asymmetries, for example, as a result of different impairment losses methodologies. Clearly, if the credit risk is shared with the policyholder, those differences will be mitigated, but it is true that if the impairment losses follow the IFRS 9 on the asset side and therefore applies the limit of 12 months on the identification of losses, the same limitation may not be applied by the insurer on the impact of credit losses on the liabilities, and there could be a difference. The staff also confirmed that an insurer would only use this yield to measure the unwinding of the discount rates in the P&L, and it would not use that to measure the liability on the balance sheet. One board member stated that he would prefer that all changes would be accounted for in the profit or loss with an explanation of the movements provided in the notes, but he acknowledged that the problem of identifying the underlying assets and their durations would add complexity, particularly for those North American participating contracts where the identification of the underlying item is not required by contract or regulation. Let's now move on to the decision-making session that took place the following day. And the first decision is around the CSM earning pattern guidance. Here the staff recommended to the board to confirm the principle that the CSM is accounted for to profit and loss over the coverage period in a systematic way that best reflects the remaining transfer of services. And the new part is that the standard will clarify that for non-participating contracts, the service is represented by the insurance coverage, which is provided over the passage of time and reflecting also the expected number of contracts in force. The board discussed whether the incidence of claims could be an equally valid approach. Particularly, they noted if the claims payouts are distributed evenly over the coverage period. The staff noted that such a situation is not common, and normally the use of a payout-based pattern would actually produce a back-end load in the recognition of a life contract profit in particular, which is not deemed to be a fair representation of the fulfillment of the contractual obligations. They also clarified to the board that the value as well as the number of contracts in force should be taken into account, leading to a blended earning pattern that takes into account the passage of time and therefore a straight line approach to earning, as well as the expectation of lapses, which will introduce clearly a non-linear component in the earning pattern, determining as a result the earning pattern to be a non-linear function of the coverage. At the end of this discussion, the chairman called for the vote, and 13 board members recommended to adopt the staff proposals, with only 3 in disagreement. The second decision is around scope. You all remember the fixed fee service contract exclusion was introduced in the 2013 exposure draft. We are now changing that again. The exclusion has now been made optional. The IASB staff recommended that this is now a permission to scope out contracts on a designation basis and to account for them under IFRS 15. It was inevitable that a number of board members commented that the introduction of options is not going to do well to the general standing and welcome of the IFRS in general. However, the staff pointed out that this exclusion in itself wouldn't create significant differences because the accounting treatment under IFRS 15 or the new standard for insurance contracts will be equivalent. And you may now understand why Deloitte, in the first place, suggested to the IASB to forget about these scope exclusions altogether, given that it doesn't have, as per their own acknowledgement, much bearing on the financial reporting of the transaction. Nevertheless, 15 board members agreed with this approach to achieve what ultimately was the Deloitte objective, and only one member of the board disagreed with the staff recommendation. The next decision is around significant insurance risk. There was not much discussion here, but it's worth reminding ourselves as to what it is, the content of this paragraph B19. It was intended, and that's the way that Deloitte always interpreted it, as a clarification of existing practices. When you have particularly survival risk, like annuities, You cannot perform the IFRS 4 cash flow test scenario of looking at different cash flows at the same point in time to establish whether there is or not a significant additional benefit being paid in the scenario that portrays the insured event occurring. You need to reflect time value of money when the payouts are just different payouts at different point in time. And therefore, that's guidance that essentially requires the identification of a scenario whereby, after taking into account time value of money, the insurer can still make a loss, is a useful clarification that shouldn't change classification outcomes, unless, of course, the insurance company has carried out that classification without interpreting the existing guidance correctly. So it is purely as a result of a clarification that an impact may exist. And on that ground, the IASB was happy unanimously in this instance to approve the recommendation from their staff. The last decision last week was on the accounting for portfolio transfers and business combinations. And here the staff recommended that the board amends the requirements for contracts acquired through a portfolio transfer or a business combination to clarify that they should always be accounted for as if they were issued by the entity at the date of the transaction. In particular, the staff asked the board to agree to amend the requirements for contracts acquired through such transactions and to clarify that such contracts should be accounted for exactly as if they were sold directly by the acquiring entity. They also indicated that in situations where the fair value was less than the insurance liability, the excess would be recorded as an additional amount of goodwill, which is what we have at the moment in the exposure draft 2013. The issue really for amendment of the standard is around transactions that acquire contracts where at the acquisition date the entire coverage of those contracts is expired. For example, a portfolio of claims liabilities. The current profit recognition principle for the CSM is that it must be fully earned when coverage expires. So this has clearly opened the question in a number of commentators as to why, with that principle, there shouldn't be a day one gain on the acquisition of those claims liabilities. However, it should be noted that the exposure draft last year already dealt with a similar fact pattern when they talked about retrospective reinsurance and dealt with that situation by imposing the creation of a CSM liability, which must be earned over the claims handling period resulting from the underlying reinsured contracts, which happen to be coincidental with the coverage of the purchased reinsurance contracts. So at that point, the IASB were able to maintain their idea of a coverage-based earning pattern. No longer here, where they had to give in to the principle and adopt a rule imposing the use of the claims handling period as the earning period that will be taken by the acquirer of those contracts to book the initially recognized contractual service margin. We had anticipated that at some point such a scenario would have come to fruition, and indeed it proves the point that we made in our letter that the linkage of the earning to the coverage period is a bright line that denies the nature of the claims handling service as one of the services that is required to be fulfilled in order to discharge the obligations under the contract, for which an equal right would exist under our assessment of the concepts surrounding the contractual service margin accounting for a portion of it to be recognized over the claims handling period. Despite our efforts over the last 3 years in both response letters to the IASB, this logic doesn't appear to be persuasive enough, and 15 board members agreed with the staff recommendations to introduce the rule that will require, in fact, the use of the claims handling period, but without extending it on a principle-based approach. One board member only disagreed from that recommendation. And that takes me to the last item of our agenda for the webcast today, which is a look at the next steps in an update on the timetable. The future meetings will be organized around the topics that still remain to be deliberated. 4 of those non-targeted topics have been dealt with today, and there are 3 more to go. And just for your convenience, I'll remind you what these are. There is an undertaking from the board to analyze the unit of account and portfolio definitions or references made across the standard to ensure that there is consistency of meaning and potentially whether there is a need to introduce further guidance to help users of financial statements and preparers to apply those concepts consistently. The second non-targeted issue is around the potential provision of further guidance regarding discount rates for long-term contracts when there is no or little observable market data. The paper from the staff on this subject has already been posted and you can download it from the IASB website. Finally, the board is committed to re-examine the accounting for purchased reinsurance contracts to check whether there are some accounting mismatches created by their decision to adopt an asymmetrical treatment on the contractual service margin between insurance liabilities and reinsurance assets. The board will also have to consider the application of the model for non-participating contracts to all those contracts with participating features for which they held the education session this month. These will include also the assessment of any modifications that may be needed to reflect these features on the overall model. And at that point, with the overall model nearly done, the board will reassess any amendments to the transition requirements that have been published last year. All these activities is expected to be completed during the course of this calendar year. At Deloitte, we believe that the autumn will probably see the end of the various redeliberations and maybe as early as October. Clearly, that will open the way to a publication of the standard in the early part of 2015. The official timetable of the IASB indicates the first half as the target date for publication. A more exact timetable at the moment is not available, and the board explained to us that this is due to the fact that there is still a degree of uncertainty from the deliberation process they need to take on the participating contracts issue to allow them to acquire sufficient confidence to make a public commitment to a particular precise date. It's important that I make these final caveats, and that is that decisions of the IASB become final only after completion of a formal ballot to the issue of a final standard. And all decisions to date, all the ones we talked about it, they are just tentative in nature and could be changed if the board wishes to do so. That is my last message for today's webcast, and as I take you to the last page with the contact details, I would like to ask for the recording to be stopped and to open the floor for any questions.